Hi, I'm Tom Lydon, editor of ETF Trends here in San Diego at the Schwab Impact Conference. And I'm here with Brian Diessner, Senior Vice President of Global X. Brian, great seeing you.
Thank you. Great to see you, Tom. Thanks for having me.
So one of the big topics here at the Schwab Conference is income. Fed, rising rates, low yields right now. What do advisors do? I know you folks are talking to advisors all the time about the same thing.
Yeah, certainly. The topic's inescapable, Tom. You've got to, all the clients are looking for our insights and advice on what's happening out there, right? And they're struggling to get yield out of the portfolios for the investors. There's a lot of conversation about many of the income-paying asset classes are relatively fully priced right now. One of the areas where we see some value is in the MLP asset category, and that's where we're having a lot of conversations now, is kind of in that alternative income space.
Yeah, so MLPs, as we know, a few years back, real popular, great yields, and kind of fell back down to earth, but now have kind of stabilized as energy prices have stabilized.
Yeah.
So tell us a little bit about that, and especially as yields are north of 7%, pretty attractive for alternative strategy.
Yeah, no, you're right. 2015 was a really challenging year for MLPs. We've done some research, and what we found is that when oil is above $45, the correlation between MLPs and oil separates a little bit, right? And that's where we're seeing oil in the range today. And I think what investors and advisors are seeing as well is that they got comfortable with how MLPs managed their revenues throughout that difficult year last year. So, that's what gives us reason to believe there's value in this category here. As you mentioned, yields in the space north of 7%, and you're looking at S&P 500 at around 2%, REITs at around 4.5%, emerging market debt at 4.5%. So there's room to really add more yield in the portfolio. That frees up space for more lower yielding asset classes inside of the total portfolio. So somebody could put tips in.
Yeah, absolutely. And the other thing is, again, rising rates tends to be not good for treasuries, especially long treasuries, right? Sometimes affect corporates and high yields, but the correlation between MLP performance during the rising rate environment, it doesn't necessarily mean that they are adversely affected when you go back historically, right?
Right, correct. And if you look at, what we're talking about here is, a 25 basis point increase, slow, rather, no one's expecting a big shock in rate increases here.
Yeah.
So at a north of 7% yield, there's room to absorb some of those increases.
And you don't need much of that 7% yield to have a pretty impressive effect on your overall yield. 5% really makes that overall yield number jump to a great degree in the portfolio. So again, diversification, alternative strategy seems to be the hot button as we're looking at 2017.
Yeah, you're absolutely right, Tom. And there's two other shifts that we're seeing taking place right now. So first is the focus on fees and DOL. Within the asset classes, advisors are really focusing on fees. Our MLPA fund, ticker is MLPA, has a 45 basis point management fee, which is among the lowest in the category. And second of all, we're seeing a shift from active managed strategies into passive. You've seen billions of dollars flow within traditional asset classes into the passive strategies. It's starting to happen in MLPs. People are holding their active managers' feet to the fire for outperformance to justify those high expense ratios. We're seeing some of those assets move to passive.
Absolutely, great points. Brian, as always, great seeing you.
Great seeing you too, Tom. Thank you.